There's a piece of advice that gets passed around kitchen tables and family gatherings all over this country, and on the face of it, it sounds like the cleverest thing in the world. Sign your house over to your children now, while you're fit and well. Live another 7 years, and the taxman can't touch it. The house passes to the children. The dreaded 40% inheritance tax is avoided, and as a bonus, you've put the family home safely out of reach of care home fees, should you ever need looking after. Simple, tidy, done. And every year, people who heard that advice and acted on it find out, often when it's far too late to undo, that almost none of it worked the way they were promised. The 7 years passed and the tax bill didn't move. Or the children's marriage broke down and a share of the house went out the door in a divorce settlement. Or the council looked at the whole arrangement and counted the house anyway. Or the children were landed with a tax bill of their own that would never have existed if they'd simply waited and inherited it the ordinary way. I want to walk you through exactly why this happens, because gifting your home is one of the few money decisions in retirement that is truly difficult to reverse, and the version most people act on rests on a misunderstanding of a single rule. If you're enjoying this story so far, don't forget to hit the like button and subscribe. Drop a comment telling me where in the world you're watching from. I love hearing from you. Before I go any further, one quick and honest note. Everything I'm about to tell you is general information to help you understand how these rules work. It is not personal financial, tax, or legal advice, and gifting property is exactly the sort of decision where your own circumstances change everything. So treat this as the map, not the instruction. For anything that affects your own home, check the official guidance or sit down with a regulated advisor, and I'll point you to some free places to start at the end. My name is Calloway, and I make these videos for one reason. The rules that decide how much of your money and your home you actually get to keep are written in a way that almost nobody outside the profession ever properly explains. I read the gov.uk pages, so you don't have to wade through 40 of them yourself. I'm not selling you anything, and I never will. Let me start with the rule everyone half remembers, because once you understand what it actually says, you'll see why so much of the standard advice falls apart. When you give something away in this country, whether it's money or a house, the gift is what the taxman calls a potentially exempt transfer. The word potentially is doing an enormous amount of work in that sentence. It means the gift is only exempt if you live for 7 years after making it. Survive the 7 years, and in the normal run of things, the value of that gift falls out of your estate, and there is no inheritance tax to pay on it. Die inside the 7 years, and the gift gets pulled back into the sum, and tax may be due. That much most people have right. The trouble starts with the parts the kitchen table version always leaves out. The first problem is the most common mistake people make when they give away the family home, and it carries a clumsy official name: a gift with reservation of benefit. It works like this. If you give your house to your children, but you carry on living in it, rent-free, as you almost always would, then as far as the taxman is concerned, you haven't really given it away at all. You're still living there. You're still getting the benefit of it. And so, no matter how many years go by, the house stays inside your estate for inheritance tax. The 7-year clock you were relying on never even starts ticking in the way you imagined. People do this, live the full 7 years, congratulate themselves, and their family discovers at the worst possible moment that the tax is owed in full regardless. There is a way around it, and I'll be straight with you about it, because it matters. To make the gift count, you would have to pay your children a full market rent to live in what is now their house, not a token amount, the going rate, as if they were the landlord and you the tenant, and that rent is then taxable income in your children's hands, so they may pay tax on it. You can see how quickly the clever, tidy plan turns into a complicated arrangement with a fresh set of costs attached. For a small number of families, it's the right answer. For most, the moment they understand what's actually required, the appeal drains away. I think of a couple I'll call Brian and Margaret, who did exactly this in their late 60s. They signed their bungalow over to their two sons, carried on living there as they always had, and ticked off the 7 years with a real sense of relief. When Brian died, the family went to deal with his estate and learned that because the pair had never paid a penny of rent and had lived there exactly as before, the bungalow had counted as part of his estate the entire time. The 7 years had bought them nothing at all. The second misunderstanding is about something called taper relief, and this one catches people who've done a bit of reading and think they've found comfort in it. You'll often hear it said that if you make a gift, the tax reduces a little for every year you survive after the first 3. So even if you don't make the full 7, you'll only pay a portion. People take real reassurance from that. The trouble is, it almost never means what they think. Taper relief only ever reduces the tax on the slice of your gifts that sits above the tax-free threshold, the nil rate band, which is £325,000. If the total of what you've given away falls within that threshold, and for a great many ordinary estates it does, taper relief does precisely nothing, because there is no tax for it to reduce. And even where it does bite, it reduces the tax owed, not the value of the gift, which is a far smaller thing than most people picture. So the family who reassured themselves that 4 or 5 years would soften the blow can find, when the figures are actually worked out, that taper relief gave them nothing. It is one of the most misunderstood reliefs in the whole system. The third way it backfires is one that even fairly well-informed people miss, because it's a tax that lands on your children rather than on you, and it can be larger than the inheritance tax you were trying to avoid in the first place. It concerns capital gains tax. When you die owning your home, something rather helpful happens. The house is revalued at its worth on the day you die, and your children inherit it at that value. The whole increase in its value over all the years you owned it, from the modest sum you might have paid decades ago to what it's worth now, is wiped clean for capital gains tax. Your children take it on at today's value and start fresh. Give the house away during your lifetime, and you throw that away. Your children take it on at its value on the day of the gift, carrying your gain with it. And because the house is not their own home, they live somewhere else. When they eventually come to sell it, they face a capital gains tax bill on the rise in value, a bill that would never have existed had they inherited it in the ordinary way. Say the house is worth £400,000 when you sign it over, and worth £500,000 by the time the children sell. That £100,000 gain is now exposed to a tax that the inheritance route would have erased completely. Families have saved a little inheritance tax with one hand and handed their children a larger capital gains bill with the other, and never realized they'd done it. If you're hooked on this story, make sure to subscribe and turn on notifications so you never miss an upload. Your support means everything and helps me bring you more emotional stories like this one. The fourth reason brings us to the thing that pushes more people into giving their house away than anything else: the fear of care fees. And the worry is a fair one. If you need residential care later in life, and you have assets above a certain level, you may have to pay for that care yourself, and for some families that has meant the house being sold. So the thinking goes, give it to the children now, well in advance, and there'll be nothing for the council to take. And this is the part I most want you to hear, because I'd far rather you learned it calmly from me now than the hard way later. There is no 7-year rule for care fees. That figure belongs to inheritance tax, and inheritance tax alone. When it comes to paying for care, your local council is entitled to look at whether you gave your home away deliberately to avoid those costs. They call it deliberate deprivation of assets. And if they decide that's what happened, they can assess you as though you still owned the house, the full value of it, even though it's no longer in your name. There is no fixed time limit on how far back they can look. Someone who signed their home over 10 years before they needed care can still find it counted against them if the council concludes that dodging the fees was one of the reasons for doing it. So the single most common motive for gifting the house is also one of the things gifting the house is least reliable at achieving. The fifth reason is the one that worries me most of all, because it has nothing to do with tax and everything to do with the roof over your head. The moment you sign your home over, it stops being yours. It is legally and completely your children's. And from that moment, it is exposed to everything that happens in their lives, not only yours. If a child goes through a divorce, the house, or their share of it, can be drawn into the settlement, and a part of your home can end up belonging to a former son-in-law or daughter-in-law you may never see again. If a child runs into serious debt or is made bankrupt, the house is an asset their creditors can pursue. If a child dies before you, and it does happen, the house passes under their will rather than yours, and may go somewhere you never intended, with you still living in it. And in the saddest cases, the relationship simply sours, and a parent who gave everything away discovers they have no legal right to remain in the home they've lived in for 40 years. There was a gentleman I never forgot, a widower who'd signed his house to his only daughter to keep things simple and spare the family trouble later on. She loved him dearly, but she married. The marriage failed, and in the division of what the couple owned, a slice of her father's home became part of the pot. He kept his room and his routine, but a portion of the house he'd bought with his late wife in 1971 belonged, on paper, to a man he'd met at the wedding and never warmed to. Nothing improper had happened. The rules had simply done what the rules do once a house is no longer yours. So let me set the central myth straight, because it's the thread running through everything I've told you. The belief is that giving your home to your children and surviving 7 years makes it safe. Safe from tax, out of reach of care fees, and certain to stay in the family. The reality is that the 7-year rule is real but narrow, that living in a house you've given away usually keeps it in your estate anyway, that the care fee fear it's meant to cure isn't cured by it at all, and that you may hand your children a capital gains bill while throwing away every protection of owning your own home. The two reasons people most often do this, beating the 40% and beating the care fees, are the two things it most often fails to do. And there is something underneath all of this that hardly anybody checks before they start giving things away, which is whether they even have an inheritance tax problem to begin with. A great many people assume they do when they don't. Every person has a tax-free threshold of £325,000. On top of that, if you leave your home to your children or grandchildren, there's an additional residence allowance worth up to a further £175,000. A married couple or civil partners can combine their allowances, which means a couple leaving a home to their children can often pass on up to £1 million before a penny of inheritance tax falls due. An enormous number of the people who tie themselves in knots trying to avoid this tax would never have paid it in the first place. Before you give away the most valuable and most secure thing you own, it is worth finding out, properly, whether the problem you're solving even exists. What I'd urge you to do about all this is straightforward, and none of it involves signing a thing today. First, and I can't say this strongly enough, don't sign anything over on the strength of advice from a relative, a neighbor, or a conversation at a wedding. This is not a decision to take on word of mouth. Second, find out where you really stand. The inheritance tax pages on gov.uk will let you check the thresholds and how the allowances work for your own situation. If you'd like it explained by a real person for nothing, Money Helper, which is the government-backed free guidance service, and Citizens Advice will both talk it through with you without trying to sell you a thing. And then, for a decision of this size, get proper regulated advice from two directions. A regulated financial advisor to look at whether you have a tax issue worth planning for and what the sensible options are, and a solicitor who specializes in estate planning, ideally a member of STEP, which is the professional body for this exact field, to handle anything that touches the deeds to your home. There are perfectly legitimate ways to plan an estate, using your allowances properly, making gifts out of genuinely spare income, putting a life policy in trust to cover a future bill, but every one of them depends on your own circumstances, and every one is worth doing correctly rather than cheaply. Giving the family home away on a hunch is almost never the answer. and the rare cases where some version of it is right are exactly the cases where you'd want a professional steering it. Let me pull it together. Gifting your house to your children can backfire in at least 5 ways. The gift with reservation of benefit rule that keeps the house in your estate while you still live there. The taper relief that almost never does what people hope. The capital gains tax bill you can land on your children by robbing them of the uplift they'd have had by inheriting. The care fee rules that ignore the 7 years entirely. And the plain loss of control of your own home, exposed from the day you sign to every twist and turn in your children's lives. If you take one thing from me today, let it be this. The 7-year rule does not make giving away your home safe. And before you hand over the most valuable thing you own to avoid a tax, make sure you've checked whether you'd ever have paid that tax at all. The most expensive mistakes in retirement are almost never the dramatic ones. They are the quiet, well-meant decisions made out of love and a wish to protect the family that turn out to have done the opposite. A few hours with the right advisor cost a great deal less than getting this wrong, and getting this wrong is one of the hardest things in all of personal finance to put right. Thank you so much for watching until the end. If you loved this story, check out the other videos on your screen now. I think you'll really enjoy them. And don't forget to subscribe if you haven't already. See you in the next story.